If you want to start making more money in the charts, such as traders like TJR, then you're probably missing this one key concept.
Fair value gaps are one of the most powerful tools in ICT style trading, and when combined with the right confidence, can completely change how you enter trades. Because at the end of the day, the market moves based on liquidity. Liquidity is simply resting orders, and you will normally find it in the external range, above swing highs and below swing lows, but also within the internal range, such as fair value gaps. Let's get into it. Fair value gaps are a simple 3-candle pattern. A fair value gap forms when the top wick of the first candle doesn't overlap with the bottom wick of the third candle, leaving a visible gap in the price. This gap represents an imbalance in the market. Buyers moved price so quickly that not all orders were filled, as we can see from this candle. The larger the gap, the stronger the imbalance, the more likely the market is to revisit it and fill remaining orders. You can draw a rectangle from the top wick of the first candle to the bottom wick of the third candle, and there you go, you marked out a fair value gap. In an uptrend, that shows that buyers have clearly overtaken sellers, leaving behind resting orders from buyers that were unable to get filled because the market moved too quick. Price is most likely going to come back into a bullish fair value gap, rebalance price, fill buy orders, and then push higher. In a downtrend, it works the same way. Price returns to a bearish fair value gap, fills sell orders, and then continues lower. A common mistake traders make is entering right after a fair value gap is getting hit. Now, just because price comes back into a fair value gap doesn't mean you should enter immediately. You want to combine fair value gaps with key levels in the market. Wait for confirmation on a lower time frame, like a break of structure or equilibrium getting filled. Then, if all of your other confluences line up, you can enter your position with much higher probability of succeeding. But day trading is more than just spotting a fair value gap and entering a position. There are many other confluences at play, which I'll cover in more detail in upcoming videos. Some people would ask, but what happens if we close below this fair value gap? This is called an inverse fair value gap, or IFVG. Fair value gaps aren't always retracement points. For example, if price completely closes below a bullish fair value gap, it's a sign that the bullish confluence has been disrespected. This shows that price is more likely to move the other way. Now we can take a look at actual charts and try to identify fair value gaps and inverse fair value gaps. As you guys know, we are looking for this 3-candle pattern. I'm going to draw it down real quick. This is the first candle, and we can see 2 wicks to the upside and to the downside, the second candle, and the third candle. As we can clearly see, the top wick of the first candle doesn't overlap with the bottom wick of the third candle, and therefore we have created this imbalance, which is also known as a fair value gap. We can draw a rectangle, and there we go, we marked out the fair value gap. The same happens in a downtrend. I'm going to draw the first, second, and third candle again. And we can clearly see again that the bottom wick of the first candle doesn't overlap with the top wick of the third candle. And we have a gap in between, which represents the imbalance. If there is no gap in between these 2 wicks, for example, if I draw the wick to the top, then we can see no gap, then there is no imbalance and resting orders, which price could use as liquidity to move lower. The market does not want to target any of that. Now we can go on to the actual charts and try to identify a fair value gap. If we look barely onto the chart, we can instantly see this fair value gap right here. We can see the bottom wick of the first candle doesn't overlap with the top wick of the third candle. We can draw the fair value gap, and we can clearly see that price moved down, retraced into the fair value gap, filled resting orders, and then continued lower. The market needs these resting orders as liquidity, so they have the potential to move lower. We can continue on the left side. We can again see a fair value gap, and price retraced into the fair value gap, filled resting buy orders, and then continued higher. Market constantly seeks for liquidity. We moved up above this 5-minute high, took out liquidity, and then continued lower. I will explain liquidity and liquidity sweeps in an upcoming video. Right here is another fair value gap. Price moved down, retraced into the fair value gap, and continued lower. It's always the same pattern and very useful in the charts. Now we can move over to inverse fair value gaps, and right here we have a fair value gap because the wicks don't overlap. We had a down move and then an up move, which caused us to inverse this gap because the green candle completely closed above the bearish fair value gap and disrespected bearish order flow. This chart layout right here gives us a perfect example. We have an inverse fair value gap and then a normal fair value gap. Price tapped into it, respected the fair value gap, filled resting orders and then continued higher. Now I will randomly look onto the market and look for fair value gaps and inverse fair value gaps. Right here again, we can see an inverse fair value gap. Price closed above the fair value gap, inversed, disrespected bearish order flow and continued higher. It's as simple as that. Right here in the top left corner, we have the same again. Fair value gap, price closed below it. We disrespected bullish order flow and continued lower. As you guys can see, I can clearly mark out numerous fair value gaps on the chart because they're everywhere and they happen every day, and we can use them to our advantage to take profitable trades. We are currently on the 5 minute. I can switch onto the 15 minute for example, and the first thing I see is again we have this beautiful retrace into the fair value gap and continued lower. On the top of this move we can again see an inverse fair value gap, price closed below it and we continued lower. We will look for one more fair value gap. Right here we have another fair value gap, price respected it, tapped into it, filled resting sell orders and continued lower. In upcoming videos I will talk about trends, higher highs, higher lows, downtrends, lower lows, lower highs, a breakout structure and liquidity sweeps. I will show you all of that on the chart real quick so you know what I will be talking about. Right here we can see a liquidity sweep. Price took out liquidity as in form of resting orders and then was able to continue lower. We will now look for a breakout structure. Right up here we can see the breakout structure. This red candle closed below it. We created the lower low, which does not exist in an uptrend. So that should be it with the video. I hope you liked it and learned some valuable information about fair value gaps. If you would like to support me, you can hit the like button, leave a comment and subscribe to my channel LM Trading. Thank you for watching and we hopefully see each other back again in the next video. Peace out.